It's time for Real Estate 101 with the Karey Brown team from Realty Executives Preferred Advisors.
Good Sunday morning to you. This is Karey Brown, broker owner of Realty Executives Preferred Advisors here in Topeka. And today I am here with David Hill. David is the president of Mid-America Bank. Good morning, David.
Good morning. It's great to be here, Karey. Thank you.
So we're going to discuss things that lenders need in a loan process. How they're helpful. You know, buyers always have a lot of questions about why are they asking me for this? Why do they have to have that? You know, today we're going to explain that. So starting with the credit report, whenever you guys get somebody and they come in and they make the application and you find that either their credit's not up to where it should be, can you explain rescoring and how that works?
Sure. Well, of course, one of the first things we do when we take an application is we do run a credit report. Of course, the main reason there is so that we can make sure that we direct them to the right program. There are so many different types of real estate loans, and of course, they all have different credit criteria. In terms of the question, though, rescoring, you know, if we had somebody that came in and had maybe somewhat of a derogatory credit report, we might look at it, and then the person might say, this is not accurate, this is not accurate. Maybe they'll give us three things that are not accurate. And then, of course, nobody can change the facts on your credit report. Only the clarification of matters can be changed. So if you've paid two or three items off that are still showing outstanding, of course, you can provide paperwork that would show that, yes, I've paid off this judgment, or yes, I've paid off this collection, or whatever the matter is. And, you know, basically, the credit report, if it shows information that's not 100% accurate, then, of course, we can update that and get the credit report rescored. It is a process. It probably takes 10, 12 days, so to speak, to rescore a credit report. And, of course, the real key is nobody can change the facts. You can only clarify anything that's not stated correctly and so forth. But anyway, hope that covers your question there. And of course, credit is a real important factor in determining the loan, so to speak. There are several things that lenders look at, but that's one of the most important items.
So just in case you don't know, you can get a free credit report from the three major credit bureaus, Experian, Equifax, and TransUnion. You can check your credit score on like creditkarma.com and myfico.com. There are several different places. Just kind of keep an eye on it. There are apps. I have like my creditkarma.com on my phone, and I just check it every so often. I was really guilty for years of not checking it, even being in the business and knowing better. So you just want to know what's going on. You have inquiries, and that does hit points on your credit score and everything else. So just keep an eye on it. Determining a budget. What should buyers look at in determining this is in my price range?
That's a good question. The industry rules and standards that we've pretty much worked with over the years would be from a housing. We look at two ratios. Some people call them the front end ratios and the back end ratio, or the house payment ratio and the total payment ratio, all meaning the same thing. But basically, in terms of your housing budget, so to speak, how much can you afford to spend on housing? We would probably say in the 28 to 33% of your gross monthly income. We think that would be a good range for you to work with. So again, 28 to 33% of your gross monthly income. Obviously, the less money you make versus the more money you make, those percentages can be challenged, so to speak. But I think that's a good place to start. On the back end or total payment ratio, ideally we'd like to see, the industry's always said 36, 38%, but in the last 10 years, so to speak, that's probably been stretched out to about 40, 42%. So if I were just, in a real quick nutshell, I would say 28 to 33 for a house payment ratio and 36 to 42 for a total payment ratio. And I might clarify that. In terms of a house payment ratio, what that means to us, that would be principal, interest, real estate, taxes, house insurance, and of course PMI or mortgage insurance if it's applicable. So those 4 or 5 things would all go into your house payment. We're not looking at utilities or things like that. So again, just those, a lot of people call it PITI, principal, interest, taxes, insurance. And of course, they don't have any, you can't add PMI in there. But those 4 or 5 things are what they look at for a house payment ratio. Total payment ratio would be your house payment on the new proposed house plus your other consumer payments, student loans, credit cards, car loans, adding all those up to come up with your total payment ratio.
That's a really great way to explain it. Thank you.
Oh, I've done it a couple times. Nah.
I bet you have. Okay, so searching for a new home. We find this a lot when buyers are looking, and especially in price ranges that are a little more challenging, they start looking at things like foreclosures that need work, but they're financing FHA. And so we have to do a little educating and say, okay, well, that's probably not going to fly with the loan product you have. Maybe you should talk to your lender about a different product, things like that. What would you say, guideline-wise, if you're looking at an FHA or a VA, you need to stick with as far as condition?
Okay. Well, condition of home, that's a really good question. And, of course, over the last 7-8 years, we've all worked with a lot of properties that are in foreclosure or in bad shape, so to speak, that people are obviously looking to buy. And I guess I would kind of look at it as from a consumer standpoint. I would look at it like this: if the house is move-in ready and able to, reasonably think that a 30-year loan is normal for that life expectancy on the home, so to speak. If it's move-in ready and has a 30-year plus life, then of course, then I think you're probably ready for a secondary market type loan, whether it be government loans or conventional. Sure, you can go on into those fixed rate products or whatever product you want to go with. I guess you could do an ARM too. I just don't promote too much of that right now, with rates being as low as they are. But anyway, if it's really move-in ready and the condition for a 30-year loan, then I would go ahead and go right into that product. If it's not move-in ready and it needs a lot of work, you mentioned FHA and VA. I don't think a VA has a program that would do a rehab on a home before you get into a perm loan, but FHA certainly does. They call it the 203 FHA loan. And so you could do a purchase and rehab with an FHA product. I really can't say that I've got a lot of experience in doing that. I probably have a lot more experience in making this transaction a 2-step process. In other words, step 1 would be purchase the home and rehab it. Step 2 would be get your permanent loan. So we've done an awfully lot of that product over the last 8 years. It's been a real common thing. If you watch a lot of TV, they call it flip housing or flipping. And from our standpoint, we look at people, we have 2 different programs that we work with. It'd be a purchase, rehab, and sell, or purchase, rehab, and rent. Or I guess, of course, purchase, rehab, and live in it. So we look at any of those 3 programs. We do those quite frequently, and they are really a good program in my mind because you buy the home, but you also get the important money to improve or get the home up in good shape so that you can reasonably expect it to have a good 15, 20-year mortgage life.
Good deal. And so when you're making an offer, it's really important to discuss that with your lender and have them run numbers. Wouldn't you agree, so that you know what your payment's going to be? Absolutely.
I mean, of course, before you start making offers on properties, I mean, obviously you want to be pre-approved so that you know that you're making an offer that you can afford and that we're not wasting everybody's time, or the most important thing, putting somebody into a home or loan that they couldn't afford. So, I like to, the first part of the process from our standpoint as a lender is our job is to educate and inform the home buyer. So we really take a lot of pride in spending time trying to educate and inform them. We want any and every offer to be totally understood by all parties, particularly the borrower making that transaction. So we want to educate and inform. Again, that's the most important thing that we can do for the first week or so of the transaction, and make sure that they totally understand what they're signing up for. We're in an interesting time with interest rates being at very historical lows. When you're doing permanent lending, so to speak, in the low to mid 3s, that's really, really a cheap interest rate. And what that does, it gives the home buyer a tremendous amount of buying power. And, it's it's been a lot easier for us to qualify people over the last few years from an income standpoint, income or payment ratio standpoint. That would be because really interest rates have been such great value and so low that the buying power is just tremendous. In a real nutshell, when we're out looking at somebody, when we're working with somebody, particularly on a 30-year type fixed rate product, the payments in round numbers, we always want to run them to be sure, but in round numbers, they're about $5 $1,000. So when you're actually making an offer on let's say a 130 home, whether it's 130 or 131, it's really not going to make a tremendous amount of difference in your payment. So I'd like to think that if they qualified for 130, they would qualify for 131 as well. We don't really want to run that tight on ratios, so to speak. So really we've had, good surprising news on that I feel like we've had people with plenty of buying power able to get qualified with these cheap interest rates and buy a lot of homes, so to speak. Just a good time. It's a good time to buy a home from an interest rate standpoint.
Absolutely. So let's talk a little bit about the process. So I know whenever we write an offer, we typically try and get a quick run through with the lender, make sure that all the numbers add up to where the buyer thinks they're going to, so that they're not making an offer and then come to find out, man, I just can't stomach that payment. And then once we have them under contract, we immediately send the contract to the lender, and then you guys run with it from there. Can you kind of explain the process to the buyer from that point?
Sure. Initially, before we send out the approval letter, we'd want to have a good, solid application and, of course, the documents to support the application so that when we know that when we're issuing that approval letter that, yes, they've got W-2s, pay stubs, and credit report and so forth, all the documents, so to speak, that would support the approval letter that we're writing. So there's quite a bit of process. I would tell any home buyer to spend a little bit of time with their lender getting qualified and set up to be approved for that home purchase before they go out and make an offer. So, but once you are to the point where you're qualified and approved as a borrower, then of course you'd start home shopping. And when you make your offer, then of course from the point when you make your offer, we should have everything approved on what we call your credit and income side of things. So we should have credit and income already taken care of. And I might just mention the things that we're looking for when we're trying to approve somebody would be, credit, repayment ability, down payment, employment. We verify that all those things are really important to us, and they'll have an impact on getting you approved, so to speak.
So while we're on that subject, I know it never seems to fail, especially when it's a first-time buyer, to understand why the lender asks for the things they ask for. So I'm going to give you the opportunity to answer those questions. So say, for instance, your most recent pay stubs, why would you need those?
A good question. Well, the pay stubs tell us a lot. Of course, number one, they tell us you're still employed. And number two, they tell us your rate of pay. And like, for example, if you're hourly or salary, or if it was commissioned or bonused, we need to look at all of those different factors, and they all have a different way of being calculated or put towards your overall application. The average person, of course, probably is a W-2 employee. And for that person, we're going to tell them, we need 2 W-2s. And for the last 2 years, I should say, might be more than 2 W-2s, but we'll need W-2s for the last 2 tax years. And then, of course, we'll want to look at current pay stubs. So if we're sitting here today, 2016, we're going to want the 14 and 15 W-2s to support that, yes, you've been employed. Yes, you've been in that same line of work, not necessarily with the same employer, but yes, in the same line of work. We want to see what your income is there. But what's really most important is your current pay stub, because, of course, that's the pay that's going to qualify you for this new loan.
And I would like to add, you guys re-verify employment prior to closing.
Absolutely. We are going to do a verification of employment. But when we have your pay stubs and W-2s, we're going to do initial verification of employment. and confirm that the pay stub, that we're interpreting it right. Yes, you're paid so much an hour, or yes, your salary is this, or yes, you're getting a commission and so forth. So we'll want to verify that with your employer, and of course the length of employment. And one thing that's really always important too is the probability of continued employment. We'll want to see that your employer answers that in a favorable manner, because obviously most people quote need to be employed to make those house payments. So it's a real important part of it. Then the pay stub, of course, gives us a lot of good information.
Right. So I know in not necessarily recent past, but in my lifetime as an agent, I have seen where people have lost their job right before closing. And they were like, well, they already verified that. Why did they call them again? Well, they have to verify that you're still employed. So yeah.
The day before or day of closing, your employment would be re-verified. That wouldn't be a full written verification of employment, just be a phone call. And obviously, when we're closing a loan for several $1,000s, we want to make sure that you're employed. That's a real important aspect of the file. And
so people that are on Social Security or disability or have pension and retirement, you verify those also, correct?
Correct. So like with Social Security, for example, we'll get the last 2 years award letters. And then when we're looking at your bank statements, we always ask for bank statements. It's also nice to be able to verify that, you get an automatic deposit for your Social Security check, and that's a good way to verify that as well. So, there's several ways to verify income, and we do utilize a lot of practice procedures for doing that, and it's really important, really important. For everybody to have success in the transaction, the lender, the people originating the loan, and, of course, most importantly, the home buyer, it's important that we all know the facts and we put people into products that they can afford and that they can it's good for everybody. We want a win-win-win so that everybody is comfortable with the transaction. I think if you follow the rules and procedures, we have a really high success rate if we do that. And I think history's proven that if we don't follow the rules or we get a little lenient on certain things, it probably doesn't work out real good for everybody. And that's not where we want to be anymore.
Okay, so another one that we have people commonly ask is if they had filed bankruptcy or in the middle of a divorce or a separation, why does the lender need to know that information?
Sure. Well, let me tackle one of those at a time. So let's start with bankruptcy, for example. Obviously, bankruptcy is a real important item to look at when you're getting requalified for a new loan. And typically, what I've found is that from a government loan standpoint, that'd be like FHA, VA, USDA, they're typically going to want to see that you're out of bankruptcy for 2 years, and preferably reestablished credit since the bankruptcy, and most importantly, that you've taken care of your credit since bankruptcy. So, bankruptcy, obviously something happened financially that created a hardship for you. And the key there is once you're through that, reestablish credit and, of course, take care of your credit. So, again, from a government loan standpoint, FHA, USDA, VA, you're looking at 2 years from bankruptcy discharge. From a conventional loan standpoint, you're looking at 4 years. And I might add, from a mortgage foreclosure standpoint, the underwriters or the industry is looking harder at the foreclosure situation than a bankruptcy anymore, and they're looking more like at a 5-year time frame to get back into a house. So, again, the key is once you've had a headache, financial headache, I think it's important to reestablish credit, and most importantly, to really take care of your credit there. You don't need, 2 scars, so to speak, on your credit report. You want to try to have none, but if you have one, try not to make the same problems or things happen again.
So when it comes to divorce papers or separation agreements, what are you guys looking for on those? Oh,
good question. On divorce papers, separation agreements, obviously we're looking for several things that affect repayment ability. We're looking for alimony as income or alimony as an expense, or child support as income or child support as expense. And also, I guess you could say we're looking to make sure that the divorce is final. We work with a lot of people that are in the midst of a divorce, and the thing we could clarify now is if you're in the midst of to me, you're either legally married or you're legally divorced. And if you're in the midst of the divorce, you're not legally divorced yet, then yes, you're still married. And does that mean you could buy a house at that point? Like, it's common that when we get into a divorce situation that, yes, the husband and wife had a house loan, and maybe one of those two parties is going to keep the house and the other one's going to go buy another house. So it's common that the person that's keeping the home to refinance it in their one name rather than having that loan remain in the two names. So that would be a refinance. And then the other thing, maybe the party that's leaving, so to speak, is going to buy another house. And if they were to buy another house, I mean, that's fine. They just have to qualify from a equity and from a down payment, income, and credit standpoint. The real key is this. If they're doing anything with the mortgage prior to being fully legally divorced, then there are the two documents that they'd be signing at closing, one, the loan, and then two, the mortgage. The note or the loan is what obligates the person to make payment. And, of course, if we were looking at people that are still legally married, we would only have the person that's going to be financially responsible sign the loan or mortgage, a loan or note. Both parties would sign the mortgage, which basically says we're giving consent to allow the lender to take a mortgage on this property that, yes, we both still have a marital interest in. So I don't know if that's, to simply put it, if you're legally still married, we would put the loan or the obligation document into one person's name, but the mortgage would be in two names. And that doesn't hurt the party that's leaving, so to speak, from their credits, from their future credit standpoint. They would not be obligated for that loan unless they sign the loan.
And just clarify me if I'm wrong, but if you're in the middle of a divorce and you go to sell a property that you commonly owned, both parties have to sign. In this market, it's one to buy, two to sell. Yeah, you're definitely going to have both parties sign the deed. And if you were doing a mortgage, you'd definitely have both parties sign the mortgage. So if you're going through a divorce and you're planning to sell, you do have to tell that other party. It can't be, we're just not going to tell them. That's true. Okay, so the next thing would be people that carry around a lot of cash and want to use that as a down payment or, things along those lines. Explain why they have to be able to explain where that money came from. That's a good question. Well, obviously, we would like to think that everybody has a checking savings account and we can easily verify the money that's in those accounts. And realistically, that's really how it should be done from a banking standpoint and when you're trying to get a loan standpoint. So if you were to deposit a large sum of money, cash, in an account, of course, there are lots of things that throws up a lot of flags and brings a lot of items to consideration that when you're buying a house. If you're buying a house, I think you just need to have your money, your cash or whatever in the bank, and it needs to be there for at least 2 months. So there are some people of different cultures it's real customary to keep cash out. But when you're getting a loan, I think it's real important to always have your money in a bank so that it's verifiable. Isn't it called curing? Like the money has to cure? It's called seasoning. Seasoning the money. Yeah, we look back for 60 days, last 2 months, as to how long it's been in your account. And we'd like to be able to verify that the money is yours, your money. And you might say, why is that so important? Well, a lot of our loan programs really want the borrower, so to speak, to have some skin in the game and some cash or down payment in the game. So all of your conventional loans want a minimum of 3% of the money to be the borrowers, so they've got skin in the game. The government loans will allow no money coming from the borrower and allow a gift for that 3% or 3.5% in FHA's case. But for conventional, it's definitely 3% from the borrower. And that's their money, not gifted money. And that's where cash gets kind of confusing. So to close out the show, let's talk a little bit about credit score. What is the credit score that a borrower would need to be at in order to come to you and get a loan? Well, that's a good question. With the government loans, FHA, USDA, VA, they're a little more lenient on credit.
And the general guideline that we work with is 640 plus. So we're looking at 640 plus as being a government loan. If you're under 640, that's a pretty hard loan for us to place with the government lenders. So that's a good cutoff for us. I'm not saying we wouldn't try something in the 630s, but if it were in the 630s, you'd need to have no recent credit history problems. You need to have, and really it doesn't matter. You can have any score in the book, but your last 12 to 24 month credit history is going to be really important. So if you've got a 750 credit score, but you've had 2 over 30s or 1 over 60 in the past 6 months, that's a red flag. That's a problem. So again, 640 plus would be a good loan for a government loan. Conventional loans, we'd like to see a 680 or higher. And I know that's probably kind of confusing because most people they just know they want a fixed rate loan for 30 years and so forth. But the government loans are a little more lenient on credit, and the conventional loans are, a little more, I'd say, conservative.
Dave, I really want to thank you for coming out today.
Oh, it was really my pleasure, Karey. This was really enjoyable, and I really enjoyed talking about this stuff.
So next week we're going to be hitting on self-employed and what you need to know, and what we call the 10 commandments of what you cannot do whenever you're in a home purchase situation. Things that could really leave you ending up in your car if you're not careful. So to get a hold of Dave, his phone number is 785-841-8055. They do service the entire state of Kansas. If you would like to check out their website, it's www.mid-americabank.com. And be sure and join us again next week where we're discussing self-employment. And again, thank you so much, Dave Hill from Mid-America Bank.
Thank you, Karey.
Thank you for listening to Real Estate 101 with the Karey Brown team from Realty Executives Preferred Advisors. Tune in again next Sunday at 11 o'clock for Real Estate 101.